Hey there! Ever wondered what the real difference is between stocks and bonds? If you're new to investing, these two terms can sound confusing. But don't worry, we've got you covered. Think of stocks as owning a slice of a company. When you buy a stock, you become a shareholder. You literally own a small piece of that business. If the company performs well, your stock gains value, and you might receive dividends, your share of profits. Now bonds? Totally different. Bonds are IOUs. You're lending money to a company or government. In return, they pay you interest and repay the loan later. You're not an owner, you're a lender. So to sum it up, stocks, ownership plus higher risk, reward. Bonds, lending plus lower risk, steady income. Stocks help companies grow. When a business wants capital, it sells shares. You, the investor, gain partial ownership and possibly dividends when profits are made. But stocks are risky. Prices can swing daily based on performance, news, and investor confidence. That's why stocks are labeled high risk, high reward. Still, the long-term benefit is big. Stocks generally outperform bonds. They're ideal if you're young and aiming for growth. And if you diversify, like with index funds, you lower your risk while still growing your wealth. When you buy a bond, you're acting like the bank. You lend money to a government or corporation and they pay you interest regularly, typically every 6 months. At the end of the term, you get your money back. Bonds are less than stocks and perfect for people seeking predictable returns, like retirees or cautious investors. Types of bonds: government, U.S. Treasuries, very safe municipal, issued by cities, states, corporate, more risk, but higher yield. But they're not risk-free. Companies can default. Inflation can reduce purchasing power. Still, they're a great way to balance your portfolio. So how do you choose? If you want long-term growth, go with stocks. If you want stability and income, consider bonds. Most investors use both. It's called asset allocation. A classic rule: 100 minus your age, 4% of your portfolio in stocks, the rest in bonds. So if you're 40, aim for 60% stocks and 40% bonds. This balanced approach helps you grow your money while staying safe during market downturns. Ready to build your ideal portfolio? Visit personalfinancetime.com and make smarter money moves today. Subscribe for videos on saving, investing, and smart money tips.